Welcome to our video where we dive into Chapter 3 of Benjamin Graham's classic The Intelligent Investor. The third chapter, titled A Century of Stock Market History, offers a fascinating overview of stock market trends over the past 100 years and delivers crucial lessons for investors. Graham explores the importance of understanding historical market patterns, how cycles of booms and busts have shaped the stock market, and how investors can use history as a tool for navigating future market fluctuations. To start, Graham believed that to be a successful investor, one must develop a deep appreciation for the long-term cycles of the stock market. He wasn't interested in short-term market fluctuations or speculative trends. Instead, his focus was on understanding how the market behaves over decades and how these long-term patterns can inform an intelligent investment strategy. In this chapter, Graham stresses that while history doesn't repeat itself exactly, it often rhymes. This means that understanding how the market has behaved in the past can provide us with valuable insights into how it might act in the future. Graham begins by analysing the broad movements of the stock market over a 100-year period, emphasising the cyclical nature of market performance. Over the course of a century, the market has experienced periods of exuberant growth followed by painful corrections. Graham refers to these as the booms and busts that have characterised the stock market since its inception. His main point is that these cycles are inevitable, and investors must be prepared for them. The chapter outlines how, during periods of market boom, stock prices tend to rise far beyond their intrinsic value. This is often driven by speculative buying, where investors rush to purchase stocks in the hopes of making quick profits. During these periods, Graham warns, it's easy to be swept up by the market's optimism and forget the fundamentals of sound investing. This is a critical lesson for any investor. Just because a stock's price is rising doesn't mean it's a good investment. In fact, during booms, stock prices are often inflated, and investors who buy into the hype may find themselves overpaying for stocks that are bound to fall once the market corrects itself. On the flip side, during market busts, stock prices tend to fall far below their intrinsic value. In these periods of pessimism, investors often panic and sell their stocks, driving prices even lower. Graham describes these busts as periods of market overreaction, where fear and uncertainty dominate the market, causing investors to undervalue stocks that are actually solid investments. For the intelligent investor, these busts present valuable buying opportunities. Graham encourages investors to remain calm during these periods of market turmoil and to recognize that good companies will eventually recover. By purchasing stocks during market downturns, investors can often buy high-quality assets at a discount. One of the most powerful messages in this chapter is the idea that market cycles are not something to fear. Instead, Graham argues that these cycles are a normal part of the market's long-term evolution, and they should be embraced by investors who are in it for the long haul. Market booms and busts are inevitable, and trying to time the market by predicting these cycles is a fool's errand. Instead, Graham advises investors to adopt a value investing approach where they focus on the intrinsic value of a stock rather than its current market price. By doing so, investors can avoid the pitfalls of buying into speculative bubbles and selling during market panics. Graham also delves into specific historical events that have shaped the stock market. He covers events like the Great Depression of the 1930s, one of the most severe market downturns in history, where stock prices plummeted and investors lost large sums of money. However, Graham points out that even during this catastrophic event, many solid companies continued to operate successfully. Investors who were able to identify these companies and purchase their stocks during the downturn were able to generate significant returns in the long run. The chapter also touches on the post-World War II boom, a period of rapid economic expansion and growth in the stock market. During this time, stock prices soared and many investors experienced substantial gains. However, as Graham explains, this period of growth was followed by market corrections in the subsequent decades. Again, Graham emphasizes that these corrections were not anomalies, but rather a normal part of the market's cyclical behavior. What's striking about Graham's analysis is his ability to separate the emotional aspect of investing from the analytical. Investors often fall victim to the emotional swings of the market, feeling overly confident during booms and excessively fearful during busts. Graham's approach, however, is grounded in rational analysis. He encourages investors to maintain a long-term perspective, even when the market seems to be on an unstoppable upward trajectory or in free fall. One of Graham's key recommendations for investors is to develop what he calls a margin of safety. This concept is closely related to his views on market cycles. During periods of market exuberance, when stock prices are rising, investors should remain cautious and ensure that they are buying stocks with a sufficient margin of safety. This means purchasing stocks that are priced below their intrinsic value, providing a buffer in case the market experiences a downturn. Conversely, during periods of market pessimism, investors should seek out opportunities where stocks are undervalued but have strong fundamentals. By maintaining this margin of safety, investors can protect themselves from the volatility of market cycles and reduce the risk of significant losses. In addition to discussing specific historical periods, Graham also explores the broader trends that have shaped the stock market over the past century. One of these trends is the gradual increase in the number of people participating in the stock market. At the beginning of the 20th century, the stock market was largely the domain of wealthy individuals and institutions. However, by the mid-20th century, more and more ordinary people had begun investing in stocks, either directly or through mutual funds and retirement accounts. This democratization of the stock market has made it more accessible, but has also increased the risk of speculative behavior, as inexperienced investors may be more prone to following market trends without fully understanding the risks involved. Graham also highlights the changing role of institutions in the stock market. Over the course of the 20th century, institutional investors like pension funds, insurance companies, and mutual funds began playing a larger role in the market. These institutions often have large amounts of capital to invest and can move markets with their buying and selling decisions. While institutional investors tend to have more resources and expertise than individual investors, Graham warns that they are not immune to the psychological forces that drive market cycles. Even institutional investors can be swept up in speculative bubbles or panic selling during downturns. This underscores Graham's broader point that the principles of sound investing apply to everyone, regardless of the size of their portfolio. In conclusion, Chapter 3 of The Intelligent Investor offers valuable lessons for any investor seeking to navigate the complex world of stock market investing. By studying the history of the market, Graham shows how the cycles of booms and busts are an inherent part of the stock market's long-term evolution. Rather than trying to predict these cycles, Graham encourages investors to focus on the intrinsic value of stocks and to maintain a long-term perspective. By doing so, they can avoid the pitfalls of speculative behavior and position themselves for success, even in the face of market volatility. The chapter reinforces the importance of a disciplined, value-based approach to investing, where patience, rational analysis, and a focus on fundamentals take precedence over emotional decision-making. As you reflect on this chapter, consider how the lessons of history can inform your own investment strategy. Whether you're a seasoned investor or just starting out, the principles outlined by Graham offer a timeless guide to navigating the stock market with intelligence and confidence.
Thank you for watching. Share this with friends and family, and please subscribe.